Hey, welcome back to Defense Like a Jedi. Hey, I just wanted to get out a quick video on Sunday. I do have, this is not an Evony video. Just want to get this out for anybody that might want to open up their app tomorrow to try to join along. I just want to show you what I'm looking for. I do plan on doing an Evony video. We'll get into that later. But if you guys did follow my last video and you managed to scoop up 100 shares of this UPXI, here's what I would look at for tomorrow if you want to trade along with me. Now, the market's closed, so these aren't going to be live price feeds. So we're just going to have to learn from it. So I'm going too fast for you. Here are your 100 shares. If you click the trade button, trade options, now you'll see it's going to come up to this, and it's going to ask you if you want a long call, covered call, cash secured put, long put. We're going to be selling a covered call. So you could click on that covered call. I don't necessarily like to do that. What I do up on the top is I click the date, and then just below that, but still at the top, I always triple check this because you don't want to hit the wrong one. So just keep in mind, if you're doing the wheel strategy, you always want it to be on sell. If you have the shares, we're going to sell a covered call. So we're selling a call, and you can see these premiums are not up to date. So we're going to need to come back in tomorrow morning. But let's just say that you bought it around $5.50, okay? Because that's the current price. I think it was a lot cheaper. Let's just take a look here. 1 week ago. So you may have been purchasing, yeah, it's still around $5.50. So we're all in that same category, or that same price cost average if you bought, since my last video. I've been buying higher than this. I bought this low as well. So the stock does move. So focus, Gene. Here we go. So if your cost average around $5.50, I'd like to get at least 50 cents a share. So that means that we could sell a $6 call. That means pretty likely that you're going to lose your shares, though. So you're not married to these shares. You just probably found out about it because of me. You're not supposed to buy stocks because of me or anybody else. You're supposed to know what you're buying. But let's just say you're not that married to these shares. So if you sell a covered call for October 24th, I'm expecting the premiums tomorrow to be at least $10, which it probably should be higher. So I'm just going to click on the plus at the top of my screen at the $6 call. And it's not even going to give me. So you can see the second column down. Okay, we're just going to sell one. The second column down, now you can see the bid-ask price is anywhere from a penny to 21 cents. A penny is ridiculous. Like, nobody would sell that. Nobody would buy that. What is the date today? The 19th. Okay, I just wanted to make sure that these weren't old covered calls because these premiums are weird. So what I'm going to do is I'm going to try to get as close to $21 as possible. When the market opens tomorrow, this price could be, and I'm no expert, I'm going to say anywhere from, you could get $10 to $25, let's say. So that's kind of what I'm expecting the bid ask to be. I'm going to aim for as close to the $21 or the $25 I can get. But if you go too high, it might not fill. Especially if the price starts coming up during the day. So typically, I would wait till after 10 o'clock in the morning, so the market's been open for an hour and a half, to let everything settle out, but that can work against you too. So because of the stock goes up, which I would kind of expect, I shouldn't say that necessarily, because this price of this stock is reflected off of Solana, and I don't think that's moved much. So we'll see. That's up to you if you want to wait an hour and a half or try to get it right away in the morning. I'll see what the premiums are when at 8:30 my time when the market opens up, and go from there. So I'm going to try to get as close to, let's say in this example, the bid ask is 21 cents a share, but that's $21 because there's 100 shares, right? So let's just say if it does open up at 21, I might go for 18. So I'm going to get 18 bucks in a week on a covered call. If the stock goes above $6, I get to keep this $18 immediately, but I'm also going to get $50 because I have 100 shares that went up 50 cents because I set my call at $6 strike. I'm going to be making money if I lose my shares. So that might not sound like a lot. We're only talking $68 in a week off of $550. So you're getting over 10% return. I feel like what do we say? $68 on $55 would be 10%. So and 100% would be 110. 20% would be 110 bucks. So we got to be 13% in a week. That's insane, right? Multiply that times 52. So don't be afraid to lose your shares at $6 because next week, what we can do is we would come back and we have all the cash, right? You paid $550 for your shares. You got 68 bucks. Now you got $618. We can sell a put. We switch over to this side. That means that we just have the cash. We have no shares. We would sell a put. You could sell it. Look at the price. If we sold it to get it back at what we lost it, right at the top one would be $6 a put, a $6 strike price for that put. You would be getting $60 instantly, maybe more. Let's take a look. So you can see the bid ask for this put is anywhere from $60 to $1.56. So I could probably get easily $100 in a week for selling a put. And now to remind you what a put is, that means that you're giving somebody else the right. You're selling a contract, giving them the right to dump their shares on you for $6 a share. So if the price goes back down to $5.50, they're going to want to sell you those shares at $6. But you just got rid of them at $6. So there's no loss there, but you would gain easily $100 premium. Maybe you could easily get $125 that week for that premium. Now, yes, you do have to keep in mind that we counted $50 because you started at $5.50 and you sold at $6 on your first contract when you sold a call. Now, if you get assigned again at $6, you can't count that $50 twice. Does that make sense? Because you bought at $5.50 and you sold at $6 when your contract made you sell. Now you're counting $50 profit. And when you get assigned back at $6, well, you can't count that $50 again. I don't know if that makes sense. Your cost average is still $5.50 a share. I'm blabbering again. I don't know. I don't know if that makes sense. Just don't double dip when you're counting your profits, I guess is what I'm saying. Because here, you're going to get another $125 premium. You're going to get assigned at $6 a share. If that price goes back down to $5.50, you're going to have to, realize that with your cost average. I realize I'm not even making sense to myself. Maybe it's hitting home a little bit, just trying to help you guys account for your gains and losses and your cost average. Not that it matters a whole lot because we're just trying to generate premiums. So if your $550 goes up or down, that's cool, but we're trying to get, I wouldn't even say $50 a week. I don't try to get $50 a week on this. I'm usually just trying to get that $20 to $30 a week, because when we extrapolate that out to when you start doing it with stocks like Tesla or MicroStrategies, something that has a good premium, but a stock that you really trust, now you're talking about making $300 to $500 a week instead of $20. So we're just learning on this micro level, risking a very little bit of money while you learn the strategy. You might set see how I set this here. I might actually accidentally set it at, 0.125. I've had, at the wrong number. And then I sold something super cheap. I've had friends that have done that where they've bought stock way higher than they could have. They just would have put a limit order, whatever. So I'm saying this is a cheap way to learn stupid mistakes that I'm not telling you, or you didn't think of, or I didn't think of. So just try to get $15, $20 a week off of this $550. I think that ROI, I don't want to do the math while I'm on the phone, it is well over 100%. If you're getting $25 a week times 52 weeks, I should use rounder numbers. That would be, that's bad. Okay, I'm going to do it again. $25 a week times 50 weeks would be 125 with another zero. Is that $1,250? I should use my calculator. So you're getting 200% APY if my math isn't terribly horrible. And if my math is horrible, that's another lesson not to trust me, to do your homework. Don't listen to a guy on the internet. Do this for yourself. Don't just totally copy and paste me, try to understand it. But again, it's a cheaper level of learning how to copy and paste me until you learn it and it makes sense. I guess that's going to be it for today. I'll just reiterate what we're going to do tomorrow, or I'm going to do tomorrow. And you're welcome to watch me. I'll post a video, and you don't have to do the cash, but I think you would learn more if you did. So I'm just going to go to trade options. I'm going to pick the date of October 24th. I'm going to make sure I am selling. I'm going to make sure it's a call. And then I'm going to look at the $6 premium. And I'm expecting it to be closer to 25. So I'll probably, if it's 25, I'll go, 0.21. Then I'll expect a better chance of it getting filled. That gives me $21 that they're putting in my account immediately. And I could go and buy 4 more shares of UPXI or whatever I want to do with that money. Just keep it on the side, whatever. What I want to do is I want to double this 550 as quickly as possible. Or maybe you make sense out of it in 2 months, and then you start moving on to a bigger and better stock where you can actually start having some life-changing money. So again, I'm selling a covered call tomorrow on my 100 shares. I could complicate things even more if I got into a different strategy for you guys. If you don't have your 100 shares, you could start in the call process, in the put process, and you could go up to, well, that's the thing. You got to decide if you want to get it at 550. You could just get $35 this week. It looks like the bid ask is 36 to 76 cents a share times 100 would make it $36. So I mean, if you just had the cash, say you had $550 and you haven't bought the stock yet, you could go ahead and sell this for 0.6 and you get $60 right now, today, and you're already up $60. Now, if the stock drops down to $5 a share, you're going to be still forced to buy at $5.50, but you were going to buy at $5.50 today or last week anyways. So there's no loss. Other than emotionally, you're starting at $5 a share and you'd be selling, calls next week at $5.50 instead of $6, but it's all the same. It's a wheel and you're generating income. Sometimes I like to be on this side better, to be selling puts because the premiums are better, but you don't get that 50-cent gain per share that you would if the first strategy where you're selling a call goes through. Man, is this making sense? Again, it's not supposed to make sense. I'm blabbering, but there's a lot. And I know you're probably not following my train of thought on these, but that's okay. You kind of get the gist of it. You get enough to start at a low risk, and you can copy trade with me tomorrow. If not, just watch along. And if you're not interested at all, I'll be doing more Evony videos for those people. I've had one person say, leave politics and religion and investing out of Evony videos. But here we are. That's me. I'm not getting anything from these videos or YouTube. So unless you use my link, which nobody has yet, other than that, I'm not getting anything out of these videos. I just want to teach you guys and show you something that I think is an amazing way to be self-reliant on your investments. blabbering again. I'll tell this story. I have a buddy who's really close to retirement, and he gave 100 grand to an insurance company as an annuity. And I feel like annuities, I'm at the age of my life where, hey, if I've made it, peace of mind is cool. So for 100 grand, he sent it to an insurance company, and in 5 years from now, he will get $1,000 a month for the rest of his life. I think that's what his annuity was structured at. So for 5 years, the insurance company gets to invest his 100 grand, and then they have to start paying him $1,000 a month. And that's like, hey, if you can get $1,000 a month, that's pretty cool. But now I'm looking at this wheel strategy. I am generating on 100 grand. I'm not doing it with 100 grand. I'm doing it with like 60 grand, and I'm generating $3,500 a month on 60 grand. And that's today. I'm not waiting 5 years. So now I really have opened my eyes to see how these insurance companies can make, ridiculous money off of your premiums. So I would not do an annuity anymore after seeing this wheel strategy work real life magic in my life. So that's that. I'll shut up now, and you guys can follow along tomorrow. Let me know, if you're doing it, if you're not doing it and still watching. All that stuff helps. Thanks. Bye.